All right, so we just talked about how finance is paid for our random luck, even though the evidence suggests that randomness very much explains performance in finance frequently. And then finance, this is a very similar topic, but finance is fooled by randomness. We see patterns, we create models mainly because our bosses are telling us to do something. And so we go out and we do a lot of data mining and we find something that seems to be a relationship. Every time this happens, this happens. Well, maybe or maybe not, but we need something. We need something in our models to give us make a decision. So we see random noise, mistake it for information. Once we see that random noise, it gets stuck. So that's somewhat of the confirmation bias. Our ideas are sticky and we're unlikely to change our minds. You're better off if you don't commit being skeptical, and we'll talk about that more with Annie Duke. I think she has some really strong, powerful suggestions on how to handle this fooled by random patterns, because our minds so much want there to be cause and effect and clear patterns. It makes us feel more secure, feel safer, but boy, we do it at the detriment to ourselves and to our clients. So withhold judgment, resist explanations. I love this phrase. He says, we are better at explaining than understanding. And that's just because of the nature of the business. It's what our bosses expect of us. Um, we think it sounds smarter to say because than accept something's random. Um, Boy, I had a boss that was just like constantly, what are you guys going to do? What are you going to do? What are you going to do next week with this data? What if this happens? And my answer was, quite frankly, we're not going to do anything because we don't know what's going to happen. We think we're positioned well. Yeah, that could happen, but also this could happen, and they're the opposites, and we don't have a crystal ball. But he felt the finance people were supposed to be forecasters, and then we had these perfect forecasts, and we just moved, and it's really quite frustrating. He wanted me to say because, so he was asking, why is the market down, or what, or why are you holding this? And you say, oh, because this is going to happen. The Fed's going to do this, or the federal government, Congress is going to do this, but we just don't know. Um, he actually complains about the educational system and that we force students to squeeze explanation out of subject matter, and we shame students for withholding judgment. We don't allow students to say, I don't know. I've noticed that some in studying some of the approach of Harvard in doing the business case. They read a business case and they're supposed to come back with this precise answer. This is what the CEO should do. You know, you're talking college students with no experience, and somehow they're supposed to give a precise answer to how to run a multi-billion-dollar company. You know, after reading the case for 10 hours or 5 hours, it's ridiculous. This precision, even in education, we have plenty of data that shows the precision is not there, and yet we force that on students. So he suggests use the word because um, as sparingly as possible. Instead of saying because, and we'll see this with Annie Duke, she does a great job with this. Rather than using phrase like because, she's going to say use probabilistic terms. So why did the Fed do this? Well, or will what's going to drive markets? What are the markets going to do next week? Oh, the stock market will be up because the Fed is going to do this. Instead, say, well, I think there's a 40% chance stocks will be up next week because of Fed action, but I think there's a 20% chance the Fed doesn't act and we could see a big sell-off. You know, speak in probabilistic terms so that you don't commit yourself, because once you commit yourself, that's all you will see. You'll be blinded by your own ego, and you'll have confirmation bias, and you just can't get off of that. Um, so you need, when you're reading articles, reading analysis, longer periods of time is better than shorter. So he would recommend, and I'm not a big fan of the Wall Street Journal. I did read it when I was at UTSA. I don't read it now at all. I read The Economist. The Economist comes out once a week. His argument is if you read something daily, much of what you're reading is just noise. Probably 80-90% is noise, but they got to fill up this newspaper, so they stick articles in there. Something happened, it's supposed to be big, but usually it's just noise, it's unimportant. So the longer period you have, so I don't know if I love The Economist because it gives a good sense of what's going on around the world, detail of every country, that something major is happening. He recommends more look at some stuff that's written once a month, but to try to give yourself a better filter so you get rid of all that noise. He says the way you can tell a lot of stuff that we read is mainly noise, then read the previous week's newspaper, and you'll see a lot of stuff. I mean, just think about that, doing that and reading the Wall Street Journal as of March 7th and March 9th or 12th, and all of that is such old information back in February or back, just before this. We started all this shutdown. I remember we went on spring break thinking we'd come back the day after spring break with normal classes, and then during spring break is when all this hit. The whole world changed so rapidly. Everything written the week before was just completely useless information because the world had radically changed. His next point is how we should not rely so much on experts and elites. And he talks about how we rarely go back and actually assess how accurate they were in the past. What we mainly focus on with elites is how confident they are, not how accurate they are. The more confident they sound, the more arrogant they are, the more we rely on them and trust them without ever asking, well, how good have they been in the past? And there's been studies on that. He talks about this in here, studies that have shown that experts are no more accurate than people with very little knowledge. They compared investment analysts to weather forecasters and found out that the weather forecasters were more accurate, but that the investment analysts had greater faith in their own skills, even though the data showed that they were worse forecasters than weather forecasters. And weather forecasters are not the greatest in the world, but at least they have some. They at least put probabilities, 10% chance of rain, 20% chance of rain. They at least put probabilities on what they're doing. But investment analysts, we make these point estimates. We're wrong all the time, and yet we're very cocky in our ignorance and our bad forecastings. And the bigger the reputation, the worse they are at predicting. The fifth thing he talks about is we ignore these rare events that are massive, even though they explain most of what's going on in the world. We ignore them because they're rare, but he says we should do the exact opposite. We should actually look at them because they tend to be the only thing that matters in our lives. And I can talk in my career. I wish we had, I like at the end of the semester in this class talking about my career and your career and where you're going and where I've been and just comparing notes. Because one of the things I really like to tell students, I have so many students that want to plan their entire career right now. They want to know exactly what they're going to do in the next 50 years. And boy, my career was heavily influenced by, I just happened to walk by someone's desk at a particular point in time. So much, just a conversation I had, and having that conversation changed everything. I can probably go back in my career and pick 5 or 6 points out of a 30-year career where those points changed everything. And they were completely unpredictable, just happened to be there. You have to be prepared and ready, but your life is going to work out in a way that it's going to be radically different than what you think, and that radical difference is going to happen because of 1 or 2 or 3 events that are going to be extremely important. So he says a small number of black swans explains almost everything in our world and explains almost everything in your life. Normal is often irrelevant. Life is a cumulative effect of a handful of significant shocks. History doesn't crawl, it jumps. It's really boring and static for years and years and years, and then suddenly something radical happens and everything changes. So we need to use the extreme event as a starting point and not treat it as the exception and just throw it out. So right now, the only thing that matters right now is the coronavirus. Maybe it's Saudi Arabia and Russia or whatever, but it's these. No one was thinking about this back in December, and now suddenly this is what everybody's thinking about. It's the only thing that matters. And we've had markets that have been pretty tame. 2017, almost nothing happened the entire year. 2019, the stock market was up 30% because we had good economic numbers. Now we've essentially wiped out that entire gain in the last few weeks in a really sudden way. So it really is stuff like the coronavirus. It really is stuff like the 2008 financial crisis that explain the world, and it's not the minutia that happens in between. I do like this. I think about this a lot when I'm traveling. when's the last time you arrived 3 hours early on a flight, or 4 hours early on a flight? You don't. You might arrive 10, 15, 20 minutes early. Maybe it's a transatlantic flight. Maybe you'll arrive 30 minutes, maybe even an hour, but you're not going to arrive 3 to 6 hours early. But boy, you're much more likely to arrive 3 or 6 hours late on a flight. So that skewness, we'll talk about the skewness here in a little bit. But one of the things I've looked at in flying, if I'm going to Houston or Dallas, is to think, well, would I be better off driving? The average would be much higher. It'd be more time, but the standard deviation would be much lower. And so if I drive, and I remember once going to Houston with a group of students, and they canceled our flight from Houston back to San Antonio. We spent the entire night at the airport, miserable. If we had driven, we would have been back probably 30 minutes later than our flight would have been. So, you know, on average, it's 30 minutes. You know, if you count all the time you spend in the airport, getting luggage and all those kind of things, you know, driving Houston or Dallas, maybe Dallas is a little bit longer, but Houston, you know, air flight is only saving you about 30 minutes on average, but it's those tail events, those times where a flight gets canceled that cost you 10, 12 hours. So you have to think about that. Think about the distribution. We'll talk about skewing here in a little bit, and Annie Frank also talks about skewing. He talks about stress tests, and some of y'all are reading stress tests in your first project on the bank risk management. Banks talk about worst case scenarios, but he says the worst case event, when it happened, exceeded all the worst cases at the time. So the worst case is not the worst case. It just, because before your last worst case, that wasn't the worst case. It just happened to be the worst case this last time. So the next time you have a greater worst case. The opposite of this, so we ignore the big events, but then we also get fooled by calmness. Everything's smooth and calm, and we actually prefer, and this is a big deal for him, and I can see this in finance a lot, we like low volatility things that have huge downside tail risk, because most of the time everything's fine, our customers pay us a lot of money, everything works out well, and then we blow them up all in 1 year. Especially the contagion. This is one of the things, we'll get this with Doug Hubbard, is this domino effect. Is when you get into the tails, the reason the losses are so much larger is because you have this contagion, this large thing that happened that rarely happens. Not only does it affect one particular asset class, but it bleeds through everything else, and things that used to be not correlated suddenly become correlated, and everything's crashing at the same time. So people are ashamed of losses, so they prefer things that have little volatility, so they don't have to say that they were wrong, but contain large losses. This is a famous saying of Taleb. It's like we're picking up nickels in front of a steamroller. We're not even paying attention, and then eventually we're just going to get smashed. Now he compares finance to aviation. He says in aviation, every plane crash makes us safer, because the system looks in detail at what happened, and they fix the system. So we'll talk about this anti-fragile here. So get into this, but it's kind of a bigger issue when we talk about the next issue, the next two issues. But you can't say this about economics. Each economic crash actually makes us more risky, and the reason for that is you have thousands of plane flights every year, and one crash doesn't involve others. Now, 9/11 was a little bit exception because you had several planes that were hijacked at the same time, but it's rare that you're going to have 2 or 3 plane crashes on the same day. They're uncorrelated. There's thousands of them, and so when you improve the whole system, you reduce the risk of all those happening. Whereas with economics, everything is so integrated, so dependent, that errors spread and compound. So good systems like airlines are set up to have small errors that are independent of each other. So mistakes lower the odds of a future mistake, because we learn. This is one of the issues people have with autonomous vehicles. The good news with autonomous vehicles, every time an autonomous vehicle has an accident, the system will learn from it. You have machine learning, artificial intelligence. The system will learn from it, and so it will improve the software for for all other cars, so cars will just get safer. But the bigger risk of that is now if all the cars are using the same software and someone hacks into the system, could we now have a system where every car could crash at the same time? So, we're looking at these systems of these contagion events. One thing causes a domino effect with everything else. He's saying with aviation, that's not going to happen because every flight is independent and we learn from our mistakes. But in finance, it's the exact opposite. So he says we need to do the exact opposite. We need to actually assume these fat tails, these huge extreme events are going to happen. We should expect high volatility, and we need to make sure that we benefit from these, that we're not crushed by these. So this is getting more into exactly what we mean by anti-fragile. His term anti-fragile. So he recommends that you take 10 to 15% of your portfolio and make extreme speculative bets, very levered like options. And what you want to do is when the whole world's crashing, that 10 to 15% is making a lot of money. On normal times, the 10 to 15% is actually harming your portfolio. It's doing very mediocrely or even bad. But when it does well, like right now during the coronavirus, you have something that's up 80,000% or 40,000%. You don't have to have a large allocation to it for it to really save your portfolio. Or you have a speculative portfolio and you insure it. This is my approach. We talked about that earlier when we talked about the use of options. So instead of putting 40% of your money in stocks and 60% in bonds, put 100% of your money in stocks, but then hedge it. You may actually have a higher expected return, but you cut off the downside risk. So that can certainly work. He says, don't try to predict black swans. No one could really predict coronavirus. Previous administrations have talked about the risk of pandemics, the George W. Bush, Obama. Previous have talked about it, but you can't say exactly when it's going to happen. So what they say is, don't invest in predictions, invest in preparedness. We're looking at things that are asymmetric. They're extreme. They don't happen frequently, but when they happen, they're far bigger than what we could ever expect. So you want to make a decision, you need to focus on the consequences rather than on probabilities. You really don't know the probability, but you can definitely look at the consequences. So he says, I'll worry less about small failures and more about large terminal failures. I worry less about embarrassment and more about missing a huge opportunity. So he says, I'm very aggressive when I can gain exposure to a black swan, a positive black swan, when a failure would be a small moment and very conservative, and when I'm under threat from a negative. So, the key is when you have skewness, make sure you are benefiting from the tail events and you're not getting wiped out by the tail events. So he's talking about skewed bets. Try to benefit from rare events. Make money infrequently. The rarity event, the cheaper it is to purchase. So options were really cheap a few months ago because we'd had so much stability. Things have been really tame for quite some time. So you could have bought a lot of insurance in your portfolio at really cheap prices because no one was worried about risk. That's the time to do it. All right, so let's talk about anti-fragility. It's a term he made up. You can tell Bill Gates in Word doesn't recognize it. Anti-fragile is not resilience. It's not robustness. Resilience and robustness are people who face volatility and they're injured, but they survive. Anti-fragile, but resilient people don't like volatility. They don't like what's going on right now in the markets. It makes them uncomfortable. Anti-fragile love randomness. They love uncertainty. And this, I think, is the most important part of his talk about anti-fragile. He says fragility can be measured, risk cannot. I think that's incredibly important. Fragility, we can measure how fragile we are. We really haven't gotten down to really measuring risk unless you're talking about games of chance, flipping a coin or poker where we know what the probabilities are. Basically know what in games of chance we can calculate the probabilities. But in finance, we don't really know what the probability of things are. We just know what the historical numbers are. We don't really know, but we can measure fragility. So what makes us fragile? Well, maybe the number one thing in finance that makes us fragile is fixed costs, like taking on debt, having contracts that we have to pay no matter what happens. Um, that's why the franchise model and the subscription model are so popular, because like an Uber can make income, but they don't have to buy all these cars. They don't have to invest in all this capital. Or Google or some of these firms that just have huge platform effects. People are paying them money, and they don't have to do huge capital investments. They're great businesses. So debt, I'd say that on a personal level and at the corporate level, high debt can make us very anti-fragile, make us very fragile. So I love that phrase. We can measure fragility. We can make ourselves less fragile. Or we can make ourselves actually anti-fragile, such that we benefit from randomness. We benefit from volatility. So that's the way to test your fragility. Is ask what happens if volatility really increases. Am I harmed materially by that, or do I actually benefit from that? Anything with more upside than downside from random events is anti-fragile. The reverse is fragile. And the last thing he talks about is try not to forecast too much. Or if you do, don't rely on it. Why do we predict so much when we know our record is so horrible? Forecasts induce risk-taking. They're more toxic than any other form of human pollution. He does not like forecasting. I don't like forecasting. I talk about it in my classes. I don't know why firms forecast. I thought it was a waste of time where I worked. People say, if you ask them, why do you forecast? The answer is always, we forecast so we can make decisions, but I never saw anybody making decisions off of forecasts. I think if you're doing forecasts, I would do it. I think I talked about this in a previous class, so sorry, this might be redundant, but it is somewhat of a pet peeve and a soapbox for me. When we talked about the article about the cone of uncertainty, is your forecast should be a risk management tool and not a try to predict the future kind of tool. Forecasts and distributions, don't forecast endpoint estimates. All right, so there's Taleb. There's a lot there. We'll see a little bit more Taleb here below, because there's some overlap with him. But what I would recommend you do on your own time, maybe after the break, after grades this summer, watch this YouTube. It's a YouTube of Kahneman and Taleb. Oops, got a typo there. Kahneman and Taleb. It's a really interesting interview. I think after reading these quotes from Taleb, you might find it interesting. I think Kahneman comes out looking like the more rational and more thoughtful person in this. Taleb got a little riled up. Kahneman's a pretty scary interviewer because he really gets to the point of things that are uncomfortable topics. But I encourage you to watch that. So next time we're going to get into this. The next class, I'm going to cut this one just to 2 videos. I've been running a little bit long. Plus, we had the live session last week. So I'll start next class with Kahneman. I love Kahneman. I do highly recommend reading his Thinking Fast or Slow. And I'll show you his videos. We'll get into what he has in the videos. I'm not requiring you to watch these videos in this class. I thought about maybe substituting these videos for my lectures. You might actually prefer that. But he's pretty well summarized down here below, I think. But I do recommend, when you have some time, to actually watch these videos and get his full arguments. Or just read his books. Either way works. Read Thinking Fast and Slow and then watch the videos. Either approach would work well. These are important topics. They help you. They're great to be exposed to when you have an interview coming up. He's covering stuff that everybody's talking about.